Hi, this is Sean in the Emerald course, Module 3. In this module, I'll be going over some definitions on this page here. Again, this page here actually can download from the kit as well. You can go through it as well, and then I will show you a general graph for securitization, a chain of title graph. Um, and again, my name is Sean, and I am just a disclaimer, I am a presenter of this information in this video. No express warranties are implied or expressed. And again, I am only a presenter of this information for the sake of this video for educational and entertainment purposes. Thank you. Okay, so in this particular definition sheet, you can actually download this from the kit as well. There are some definitions here. I'm not going to go over every single one. However, I will go over the main ones that relate to the next graph that I will show you in the PDF document that shows a securitization chain of title type transfers. So here in this particular page here, you will see issuing entity. Obviously that's an important one. The issuing entity provides the securities for the investors, which purchase the securities from the issuing entity. Okay, so it's kind of like the securities are purchased from the issuing entity. The investors basically, when there is a securitization, right? Obviously with the securitization of debt, mortgage, auto credit, other types of debt, and some of these large securitization trusts and bonds, there are investors that invest in them. So obviously when an investor purchases, like let's say, John Doe purchases, 10,000 shares or a 10% share or 5% share, of a particular securities, for example, then the issuing entity is going to provide those securities, provide the documentation, those related type of things. That's what the issuing entity means. An investor, obviously, that's the investor, the investors that invest into it, or basically, if you see some of the screenshots, the financial screenshots, um, under the holdings tab or the investors section, or some sections that show you the investors or those that are involved with the investment into the bond or the securities. You'll notice there are large corporations, large corporations with large holdings that invest into the bond and the securities. Um, And that's one of the things about these securitization and these bonds is that you have other large companies that are investing in them as well. I mean, these are some very big names. Um, so yeah, that's basically what that means here. And the other definition here, the custodian and the servicer, and you could read here, basically says involved in the act of collecting the cash flows as well as distributing them. Custodian also acts as a middle entity between the owners of the securities. A custodian bank or simply custodian is a specialized financial institution responsible for safeguarding a firm's or individual's financial assets and is not likely to engage in traditional commercial or consumer retail banking such as mortgage or personal lending, branch banking, personal accounts, ATMs, and so forth. So, the custodian basically relates to, the middle entity, between the owners of the securities. Okay, it's basically a custodian, record keeper. It's creating, maintaining records. So basically being a custodian in a sense. Um, the cash flows, the managing of them, usually that's done either by the custodian or the servicer or vice versa. Sometimes you'll have one that has, you'll have one, and for example, in some of the securitization reports, in the transactional parties section, in the report, you'll see, multiple companies involved, and so you'll have them listed there. And so you'll see, okay, who's the custodian, who's the servicer. Sometimes the company might have absorbed maybe both, or it's like custodian slash servicer, they do both. So just keep that in mind as well. Obviously the lender is going to be the lender that is funding the loan or providing the loan, right? And then here you have obviously the trustee, it's an entity which manages the payments to the holders of the certificates, the pass-through certificates, we call them, right? Sometimes you'll see a name of a trust, right? So a securitization trust, right? You'll see the name of the trust that actually has pass-through certificates or something relating to that in the name. So you'll have like, I've looked at many, many trusts in my career. Um, You'll have the securitization trust, like for example, I usually like to use fictional banks, right? So let's say Bank of Blue Wonder, Trust 2006-1AB, certificate holders dash A. So that's an example of a trust securitization name, something along those lines. So, that's keep that in mind as well. But yeah, the trustee is obviously the managing the payments, the certificates and those type of things. And again, there's another additional to that here as well. Then you have the underwriter. Now, underwriters are important, very important because when you look at the front end underwriting of a lender or a bank, right? So when a client submits their documentation to a bank or a lender, there is an underwriter at the bank. It could be a team of underwriters. It could be a main underwriter. It could be, obviously there's sometimes you'll have like the main underwriter, and then you have the subsidiary underwriters below them that are doing some of the front end, and then the main underwriter will take over. And I myself have actually studied underwriting as well. I do have a certification in underwriting. And basically, the underwriting is basically, they are looking at a loan application and basically checking, the documentation, checking if it fits into the loan program that it's being applied for, or maybe they might change the loan program, looking at the documentation, looking at the employment documentation, seeing if the employment lines up, seeing if the documents line up properly, seeing if the ratios line up. It's a very comprehensive job, and I actually respect underwriters a lot, and they have a very important job. Um, and there is also software that can be utilized as well. But yeah, you have the underwriter who is actually underwriting it, and it's very important to the entire loan process as well. Now, skipping sponsor here for a second. Now, you also see the underwriter for the securitization side. So there's underwriting on the securitization side. Like sometimes when you look at a pooling of service agreement or prospectus, you will see underwriter listed there. So that's the underwriting relating to the securities. Okay. So, here it says the underwriter creates the securities and arranges to place the various tranches of securities, different classes of certificates with investors. The underwriter then transfers the mortgage portfolio and securities to the issuer. So, here is in a situation where you have underwriters that are actually underwriting the securities itself, okay? And, creates the securities and arranges to place the various tranches of securities, okay? So basically, when you have a securitization trust, let's say, for example, a securitization trust, Bank of Blue Wonder, again, fiction, this is a fictional name that I'm using for example purposes. Let's say they are actually securitizing mortgages into a particular trust. And in this particular securitization trust, this trust will have a database, okay? And like I myself was a database researcher early on in my career. And so you could actually go on, the particulars, the software, the terminal, or the public database, and actually pull a database of the loans in that trust. Now, in that trust, you'll have different tranches. Tranches are basically another word for sections. So a tranche is a section of that database. So, for example, let's say Bank of Blue Wonder has a trust, and they sent in 100 loans into this trust. Okay, 100 loans that they funded on their front end, transferred, and now sold it, transferred into the trust. Now, this particular securitization trust could, let's just say for the sake of this example, could have 4 tranches, okay? And so 4 tranches, if you divide that evenly, that's going to be 25 loans in each tranche, okay? So, for whatever reason, they're placing, they're segmenting the loans. So let's say the first 25 are loans that are under 100,000, and then the second 25, and again, it could be like A, B, C, D. So tranche A dash one could have 25 loans. All of those loans are under $100,000. Okay. Meaning that like the people, the clients that obtain the loan under $100,000 balance range, are they going to segment it into that tranche? Okay, now there are various reasons why they do this. It's organizational reasons, other reasons, it could be, they want to keep records a certain way. So again, they're dividing the loans into different tranches. Okay. And then the second tranche, could be loans that are $250,000 and up. So in the tranche B, which is the second tranche, right, of the other 25 loans, all the loans in that tranche, which are 25 loans out of the 100, 25%, right? Could be loans that are over $250,000. And then tranche three, which you could say, tranche three dash C, that could be loans above $500,000 loans. So like all the people that had loans $500,000 and up for the mortgages are in that tranche. And then the fourth tranche could be like basically, let's say tranche 4-D, all the loans above $750,000 are in this particular tranche. Okay, so that's just to give you an idea of how and why they would divide up a pool of loans into different tranches. Very simple example so that you get an idea. Obviously, it's more complex than that, but that gives you an idea because tranches is one of those words that people kind of throw around, and then there's CUSIPs, right? So now going to the CUSIP, right? There's a main CUSIP that identifies the main securitization trust, which is Bank of Blue Wonder dash 2006 1A, right? Again, this is fictional. And so each of those four tranches that I mentioned could have its own CUSIP number, okay? Those are the sub minor CUSIPs. So the minor CUSIP. So uh, the first tranche 1A could have one CUSIP. The second tranche dash 2C B could have its own CUSIP. The third tranche 3 dash C could have its own CUSIP number, and the fourth tranche 4 dash D could have its own CUSIP. So you have four separate minor CUSIPs identifying sections of that database. Again, it's a database of loans divided up into different sections, which means tranches. Okay. Now those tranches, each each tranche, there's four tranches. Each tranche has its own identifier and its own, okay, 1A, 2E, 2B, 3C, 4D, and then it has its own CUSIP. And that's to give you an idea of how they divide these up. And so me, myself, as a database researcher, I actually would go into the database and go through some of the lines and actually see people's loans in there myself. And that was one of my functions and tasks early on in my career. And it was interesting to see the amount of loans, the amount of in loans and in this particular database, in these databases that I was looking at, all of these different securitization trusts. It's very interesting. So yeah, there's actually a database in there. So and this is big with mortgages as well. So that's just give you a key piece of information, and I hope that gives you an idea because that again, that's one of those things that people kind of throw around, and there's a lot of different ways. There's a lot of different types of, I guess, CUSIP, what CUSIP number means, and so that's one way that as far as your own learning and your own research go, that's one way that it's used. One way that a CUSIP number is used is to identify different parts of a database within a securitization trust database of all the loans in there. Okay, so just keep that in mind. Um, and that there, it kind of it gives you an idea. Okay, that's how the organization is done, and that relates to the CUSIP. CUSIP is obviously another term that people obviously are talking about, and a term that gets thrown around a lot, but it's very important information, obviously. And then lastly, on this page, I will just go over the sponsor really quickly before I go into the next section here of the PDF, of the other PDF. So the sponsor is the entity who purchases the loans direct from the originators, then packages them into pools, and moves forward with the selling them to depositors. Okay, so basically, it's saying that it is the entity, okay, purchasing the loans, okay, from the originators, right? Could be the banks, could be the lenders, whoever is originating the loans, as far as the funding goes, right? So this is going to be post note. So after the note, the mortgage note is signed, as a process. So just keep that in mind. So there's a process involved in that, and then the sponsor is then purchasing these loans, okay? And then, like, let's say, for example, it purchases the loans from, let's say it has, 20 loans that it purchases, right? So then it'll take those 20 loans. They might take divided by two. Again, very simple example. I'm giving you 20 loans. They might divide it by two, and they might sell the first pool A. They'll call it, let's just say the first 10, they'll still sell it to one pool, and then the pool two, they might sell it to a different securities pool. Or they might take all 20 loans and sell it into the same securitization pool. So the pool of loans, right? Then all these loans get pooled into a database, and then it gets into the securitization, and it gets divided up. But that's the sponsor is relating to this, is what I'm saying, is relating to that process. Now, with the secondary market of the banks and the lenders, okay, when the loan gets funded on the front end, okay, there are the lenders and the banks, a percentage of them have a secondary department. They have it could be in some of them, from what I understand, there is an office, or it could be, at a different location where they have, and basically, you got guys in there, kind of like a Wall Street trading room in a sense. And you have guys on there with these computers and these software systems that plug into the secondary market. They could have a terminal as well on there. And basically that's what they're doing. They're packaging loans from, let's say that department could work for a bank, or maybe they're working for multiple banks. It could be different things. But from what I have in my experience over the years talking to professionals, I remember talking to one individual, and they were telling me about a particular bank that had an office inside of their building. And basically, I believe it was a lender back during the tail end of the refi boom. Um, and there was a room in there, and there was it might have been one or a couple individuals in there, and they had a software system on the computer, and yeah, they would, the front end, the loan gets funded, the underwriter obviously approves it, the loans get funded, and then those go into that secondary department where these individuals are sitting with the software, and then they're bundling them up. They are in the software, bundling them up, dividing up the loans into different pools or packages, and then selling them either to other banks or securitization, trusts, other big financial companies. It's just an entire market. It's called the secondary market, and that's something that the banks and the lenders are involved with. And then obviously with the whole securitization, you see, where the loans are sold and then securitized into pools and trusts, into securitization trusts, into pools, and then backed by a bond or securities, and then they make even more money. So, all that relates. It's all interlocking, and it's all a market on the secondary market. So just keep that in mind moving forward. And I hope that gives you an idea of kind of what goes on. It's kind of like retail and wholesale. I mean, you go to the store, and you're walking into a store to buy clothes, shoes, um, and obviously you're paying retail prices, right, for those items, but you're physically walking in, right? Just to give you an example. But obviously that store has purchased those items wholesale, right? And they bring it in the back, and they have a storage in their back unit, the store or somewhere else, and they're bringing them in the back and putting them in the store, right? It's just to give you a simple example. Um, so obviously with the banking lending system, you kind of have that same concept in a sense, right? I'm getting my loan, from the front end, retail, and then they have their own secondary market, wholesale, okay? Wholesale could mean to them, selling the loan, securitizing it, transferring it. There's a lot of things that goes on. So just keep that in mind. And so this particular document here, um, This, in a sense, is a along the lines of a chain of title overview type of graph, okay? In a sense, basically showing you transfers of a particular um, type of debt. It could be, different types of debt as well. But basically, this shows you here from the beginning here, okay, all the way to here. So here you have the borrower, okay? Um, and so this particular section here, you have the borrower, okay, the consumer in the beginning. And then basically you have these arrows and it shows you, okay, the agreement or let's say the contract, right? So let's say it's a loan agreement or a note or a finance contract or a credit card agreement or a credit card, those type of things. And so you'll see, like, for example, obviously this is a title escrow, so that's going to be mortgage, right? So in this particular example, but again, it's the same concept for other types of debt, same similar concept, okay? So basically, it goes to title escrow, title company, they maintain the assignment history, and basically, for those of you who do not know, or are new to this area, the assignment of mortgage document basically is a document that is filed at the county. For example, and this is for mortgages, this particular example. You have mortgages, right, that are sold or transferred, securitized, you know, the company will file an assignment, or another company, like let's say, the company purchases it, they could be connected, so they file it. Well, somebody connected is filing it at the lender or the bank along those lines. So that assignment of mortgage document, also called the corporate assignment of mortgage document, is filed at the county. Now, I have seen in my career files with 10 or more assignments filed at the county, meaning there are 10 separate documents called the assignment of mortgage that are filed at the county that shows a trail of it's being sold, transferred between multiple companies. Sometimes they file what is called a corrective assignment of mortgage. The corrective assignment of mortgage, they're correcting an assignment that was already filed at the county. And if I would recommend take a look at the Robo scandal. Type that on Google. You could. There was a 60 Minutes. 60 Minutes show did a segment on the robo signing scandal that relates to these documents. Okay, so those documents are basically indicating a sale or a transfer. So, for example, if one bank sells a loan to another bank, then they might file the assignment, or there might be MERS involved. There might be the mortgage electronic registration system. There could be a securitization involved. There could be a trust involved. Again, but that's what it indicates, either sale, transfers, or some type of adjustment, going on relating to the loan. Like it could be like it could be going into a trust, or, the bank could file it, naming something. But many times it's indicating a sale or a transfer from what I've seen. But just along those lines. So, especially with files that are securitized or been sold multiple times or transferred or securitized, you'll see those assignment of mortgage documents. And, that's one of those things where you have to kind of pull a title. You need to pull a title report to see that. And then you can see, okay, you will see on there assignment of mortgage, maybe one or two or multiple ones. And then you can go and pull those documents and read the verbiage. And so, yeah, that's what those indicate, and that's a very important part of the whole securitization auditing process, because it indicates, the sale or the transfer, and not only that, there can be an analysis done on the document, for anything relating to maybe the document, or like I said, there was a robo scandal in the past of robo signing. Robo signing was basically something where it had to do involved with stamp signatures and signatures being, there's just some funny business going on there. And if you watch the documentary, that will explain it. But yeah, there was some issues relating to that I would highly recommend you guys look into when you have a chance. But yeah, moving forward here. And so then this graph shows you the creditor or the originator. The monthly payments go there. Obviously, the creditor originator is going to be the bank or the lender that the borrower has the loan with. Okay. And then when you see here, this is an important note on the left-hand side here. It says the note was split from the agreement. So keep that in mind. This is where you see the splitting of the note, you know. Also, there are situations where like the note could be split from the deed of trust, the notes being transferred. Again, that's an important part of the securitization process. That's an important part of the research, right? Seeing what happened with the original note, what happened with the original documentation, where's the debt, where's the note, who owns the note. This is part of the process and the research. And as you see here, it will say note was assigned and transferred to the seller. And you see here again, it's purchases loans from originator, forms pool. So here's the lender, sells it here, okay? And then you have simultaneous, sometimes you'll have, again, this is in dots, master servicer. So this is a servicer and services individual loans, aggregates collections, performs duties under trust, pooling, and service agreement. That's the master servicer. Okay, that's on the trust side. Okay, also could be connected to the loan as well. Okay. And the seller going down to the depositor, again, creates the issuing entity. The trust fund issuing entity holds pool of loans and issues certificates. There it is again, okay? And you see this is the process. Lender to seller to depositor to the trust fund and the issuing entity. And then goes back to the depositor. And then the certificates are issued here. Okay, and here's the underwriter's function here. These certificates are sold to the investors. There you go. So the investors are coming in from the outside, investing and purchasing the certificates. Okay. You could technically, in a way you could say, okay, are these like stocks, right? They're purchasing stocks, right? Certificates / stocks. So that's kind of what that is in a sense, for example purposes. And then the certificates, here. And then you have the trustee for the trust, represents investors' interests, calculates cash flows, remits net revenue. The underlying custodian, the document custodian. See, there's a custodian here. Again, keeping track. That's what the custodian does, keeping track of the documents. And then a return on investment, of course, maintains assignment history, maintains the record keeping. Okay. So that's one thing, you can pause and kind of look at as well. But that gives you an idea, in a sense, of what is going on, and how some of these different, like the master servicer and the depositor and the underlying custodian, how it all kind of fits, okay? Now, this is more of a general graph, okay? However, it is the similar concept to other types of debt as well. So I would definitely recommend you maybe pause this section and kind of read through this and kind of get an idea. And there's also an arrow legend here you can kind of look at as well. But yeah, that gives you an idea of, okay, the path of a note, the path of a debt, what's the concept here? What is the underlying lesson? Well, the underlying lesson really is, that these notes and these debts are being transferred around, right? Multiple times they're being put through into these different entities, and there's a path. And what is the function of our research? What is the function of what we do? Is looking at this and looking at this graph and seeing what is actually going on here on the back end. This debt is being sold, transferred. This note is being sold, transferred around, and there's all these different entities involved. And what is the end goal here? There's obviously it's profitization, right? They're profiting, they're making money, they're making interest, they're making dividends. Anytime you have investors, especially if you look at some of these bonds and these securities, these investors are some very large, wealthy corporations with a very high amount of assets sitting on their books, okay? And so these large corporations are coming and investing into a securities trust that has all of these notes, all of these loans that are being transferred into them, and we're talking millions of dollars here. So really, that's the underlying lesson. Look at this, understand it. know that what is really happening here? Well, it's profits. It's profits on a different type of scale. It's taking a note and taking a debt, selling it, transferring it, putting it into a trust, and then getting investors to invest. And then the investors are getting certificates and they're benefiting from it financially. They're making money. So that's really the underlying lesson here. Recommend pausing and kind of taking a look at this graph. This is important to grasp, especially in this course. But yeah, but I thank you guys for watching this video, and we will continue. Thank you.